Hey guys, welcome back to my channel. Every trading guru or book might tell you buy this when certain candlestick pattern appears. But do these patterns actually make money? Let's see. Instead of guessing, I wrote a Python script and backtested it on the 25 years Nifty daily data. I have backtested 5 popular trading strategies that I am going to show you today. And then I have simulated trades with exact stop loss and take profit so that we will get an idea. The results are surprising. Some patterns are loss making, but others made profitable. Stick around to see which patterns are performing the best and then which are performing the worst. So what I'm going to show is first all the patterns and then rules for backtesting, and then I'm going to show you the results and my recommendations. So first pattern we are seeing is a bullish engulfing. The first rule is first candle should be bearish, means red color, and then second candle should be bullish, that means green color. And this green candle should completely engulf the body of the red candle, that means it should open below the red candle and then it should close above the red candle, just the body, not the wicks. And for backtesting I am going to use 3 simple rules. The entry will be next day open, and stop loss will be the low of the pattern. Take profit will be 1:2 risk reward ratio. Both the SL and TP is not hit, then after 30 days we are going to exit the trade. Let's look at the couple of examples. So here you can see red candle, green candle, fully engulfing the red candle, and then the entry will be next day open, and then we are going to place our stop loss over here, and as you can see stop loss is not hit, so we are going to exit in this candle because we are going to hit 1:2 risk reward ratio. In the second example, same bullish engulfing pattern and then entry over here, and then since we are not hitting the target and then SL is here, so in this candle we are hitting the stop loss. Next pattern is called hammer. So it is a single candle pattern. So we should see small body near the top and there should be a lower shadow and it should be very long. So in general, if the body size is this much, wick should be 2 times of the body, and then top wick should be 0.5 times of the body. So it should be greater than, it should be less than. And color of the candle is not very important. Again, same rules. So there is no change. Next day open entry, SL is low of the pattern, target is 2 times of the stop loss, and then if both of them are not hit, exit after 30 days. And these are the couple of examples. So you can see this is long candle wick, a small body, and then very little top shadow. So we are going to enter here, and then since our stop loss is here, you can see we are hitting our 1:2 target in this candle. The loss making trade, same hammer pattern, and then entry here and SL here. You can see in next candle we are hitting the SL. The third pattern is a piercing line. So first candle should be bearish and second candle should be bullish, and we should mark the 50% of the body of the first candle. The rule is simple. So here it should open below the previous candle low, and then it should close at least above the 50% of the line that we have drawn from the previous candle. And the rules are pretty much same. Here you can see this is a red candle and this is a green candle, and it has opening below the low of this candle and then closing above the 50% of the body. And then we are entering over here. This is the stop loss since we are entering here. So 1:2 will come approximately here. Similarly on the loss making trade, you can see this is a red candle, green candle, and then it has opened below the low of the red candle and closed above the 50% of the red candle. And then entry over here, and SL is here. You can see in this candle we are hitting the stop loss. And the fourth pattern is bullish harami. So first candle should be bearish and it should be very large, and second candle should be bullish and it should be small, and then this body should be within the body of the previous red candle. Then we have a harami pattern, and the rules for entry, stop loss, take profit is exactly same. And here you can see big red candle and small green candle completely within the body of red candle, entry over here and take profit over here and SL over here. So we are hitting the profit in this particular trade. Similarly, if you look at this pattern, big red candle, small green candle completely inside the red candle, and then our entry happens over here and stop loss is here. So you can see in next candle we are hitting the stop loss. And finally the fifth pattern is called the morning star. This is a 3 candle pattern. So first is the bullish candle and it's a very big candle. Then there should be a small candle. The color of the candle doesn't matter. It can be green or red, but it should open below the low of the body. So basically gaps below the candle one body. So this is opening the below the candle body, and then third candle can open anywhere, but it should close above the 50% line of the previous red candle, and the rules are exactly same. And then these are the couple of example. You can see big red candle and then small candle opened below the low of the body, and then there is a green candle which is closing above the 50% of the previous red body. And then we are entering over here next day, stop loss is here, and then we are hitting the target after few candles. Same thing on the other side. This is a red candle, and then this candle is open below the red candle, and then this candle closed above the 50% of this candle, so it is satisfying the morning star pattern. And then we are entering here. Since this is our SL, we are hitting the stop loss in this particular candle. So let's see the backtest results of whole thing. So I have backtested from 2000 January, which is like 25 years of data till 2025, and then I am using the Nifty daily data, and then I have used Python to backtest this whole data and all the patterns. And here is the summary. So these are the 5 patterns, and then these are the metrics of the backtest. And then the most win rate can be seen in the piercing line pattern, which is a 42% win rate. The total returns is 86% in bullish engulfing, with a 19% drawdown, which makes the total return by drawdown ratio 4.49. And this is the metric that I am comparing across all the 5 patterns. Hammer made the loss. So compared to 4 patterns, bullish engulfing is clearly a winner. So this is not a CAGR by drawdown or a annual return by drawdown, which is a total return by drawdown. I just used for the comparison purpose. And then profit factor is also close to 1.5. Risk reward ratio is 2.2. On an average, in every trade, you make 0.45%. So the winner is clearly bullish engulfing, so which is a red candle, and green candle should completely engulf the body of the red candle. And then you take trade on the next day open, and low of the pattern is SL. Take profit is 2 times of the SL. But you need to remember, none of these patterns are as good as simple buy and hold strategy. What is buy and hold strategy? Imagine you are buying the Nifty in 2000, and then till today you would have made 1446%, but here the drawdown is 65%. So in a way you have to go through 65% drawdown if you do simple buy and hold. But if you do one of those patterns, you are not seeing that much drawdown, but your returns are also very limited compared to buy and hold. So data doesn't lie to us. You can see the candlestick patterns are useful, they are making money, but they are not good on standalone basis. In your existing strategy, you can use this as a filter. That means if you are taking too many trades, you take only the trades when bullish engulfing is forming. So that way you will improve your probability of making profit. Like I always say, you cannot make money with single strategy. You need to have pool of strategies. So if you like this video, hit subscribe for more videos like this.